Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm joined by Jarrod Kerr, who's the Chief Economist at Kiwibank. Welcome, Jarrod.
Thank you.
And Jarrod is here to review the Reserve Bank's monetary policy statement and official cash rate review on Wednesday. Jarrod, yourself and every economist, observer, pundit, whoever who's been watching the RBNZ expected a 50 basis point hike on Wednesday, and we got it. But the hawkish tone from Adrian Orr and co, I think took many of us by surprise. I guess that they used the word resolute. They're resolute about fighting inflation. I guess that is their key job. So is this a case of the Reserve Bank trying to do its job?
Yeah, absolutely. The Reserve Bank of New Zealand sort of prides itself on being one of the first inflation-fighting central banks. And here we are with inflation at 7% and their target is 2%. So they've got a lot of work to do. And what we were surprised by in the statement on Wednesday was the extent of the work that they think they have to do. They're now telling us that they're going to hike the cash rate to 4%. That's up from 2% today. So interest rates are rising and they've got a lot further to go.
And I mean, they're rising quickly too, aren't they? Because as recently as October last year, the OCR was 0.25%. So we've come quite a long way already. I mean, Adrian Orr played that down a little bit because he was saying we're sort of getting back to the starting line, if you like, the I guess the neutral rate, and then going up. I mean, I guess the question is, at what cost could it be to go so hard against inflation to the broader economy?
Well, you're going to see quite a sharp slowdown in consumption in New Zealand. I mean, household budgets are really going to feel the higher interest rates which are coming through now. Interest rates, as you say, have been ratcheted up from the lows of last year. You could get a 2-year, 3-year mortgage rate in the low to mid 2s. Now we're in the 5s. And given what's coming through, it looks like interest rates are going to rise into the 6s. So that's a huge increase, more than doubling of interest expense for households. And that's going to have an impact.
One of the things that we have been watching, and we were just discussing when you came in before, that none of the banks have moved yet. So we're sitting here on Friday, so I guess we're nearly 48 hours after the decision was made, and usually when the OCR moves, the banks will move mortgage rates, deposit rates quite quickly. They haven't yet. Do you think this is a case of them being taken by surprise, or no one wants to go first? I mean, what's going on here?
Well, we all expected the 50 basis point move on the day, but we did not expect another series of 50 basis point moves. And the central bank came out quite clearly and said that they're going to continue to move briskly, which means they're going to continue lifting in 50 basis point increments. So we could have a 3% cash rate by August. And that obviously has pushed wholesale interest rates higher, and banks use wholesale interest rates to hedge their exposure on mortgages. So I think it's a little bit about letting the dust settle, letting the market settle, letting wholesale rates settle, and then deciding how to price the different mortgage rates across the curve.
Now, of course, on top of inflation in the RBNZ's monetary policy targets, they've also got this maximum sustainable employment target. Whatever that is, it's always a moving feast. Yeah. But they're obviously saying that we're well above that. We're above that now because unemployment is so low. I guess to what extent? I mean, Adrian Orr's played down having the employment target in there and said that it wouldn't be different. They'd be doing the same thing whether that was there or not, in terms of how they're aggressively trying to fight the highest inflation in 30 years. What's your read on that? And also, I mean, what is it going to do to the the labour market and the employment market if they do raise the OCR as aggressively as they're saying they will?
Well, for starters, you're right. We are through what we'd consider to be full employment. Full employment's around 4.25%. We have an unemployment rate of 3.2%. So we're well through what you consider to be full employment, and that's going to generate a lot more inflation. And one of the big changes in the Reserve Bank's monetary policy statement in their forecast was their outlook for wages. they've got a much larger spike in wages coming through. So that's your second round effects. That's where inflation becomes embedded and continues to increase. So I did ask, how did you come up with these forecasts and why? And the answer was, well, inflation's running at 7%. Real wages are at really low levels, and with such a tight labour market, we can't see that continuing. We can only see, quite significant wage price pressures coming through. So they've got those second round effects coming through, and in order to stay on top of inflation, they've got to go that much harder.
Now, obviously, mortgages are, for people who've already got a mortgage, they roll over fairly regularly. Most New Zealanders take out maybe 2-year rates, 1-year rates.
Yeah.
And I think you and I spoke about this before. Is it 60%-ish is up for refixing in coming months? So, potentially the Reserve Bank could get quite a lot of bang for their buck reasonably quickly with this. So it just makes me wonder that whilst on the face of it they are being very, very hawkish with this statement this week, in the background are they perhaps hoping that they don't have to go as high as 4% with the OCR?
Well, I think that they would love to not have to go to 4% because it means that they've done their job earlier and with a shallower OCR track than expected. That would be a great outcome. What they're really signalling is that they are going to do what they have to do at any cost to get inflation down. And I think it's that stern message is really about getting inflation expectations back down. What we've seen is inflation expectations, so people's thoughts of where inflation's going to be in 1 year's time, in 5 years' time, 10 years' time, they've all crept higher. And that's material for a central bank. When you have people telling you that inflation's not going to be at 2% over 5 to 10 years' time, that's the credibility of the central bank that's being questioned. And when your credibility is being questioned, you fire up and you do what you can to get inflation expectations back down to 2%. So I think they have come out very strong. I don't think they have to deliver the full 4% cash rate. I think they'll end the cash rate somewhere between 3 and 3.5. I think that's more than enough for the reasons that you've mentioned. We are getting good bang for buck on mortgage rates today. But look, this is a central bank that's telling you it's going to do whatever it takes to get inflation down.
Obviously, at the best of times, there's a lot of uncertainty in the world. And right now, we are still wrestling with COVID. We've got the lockdowns in places like Shanghai that's jamming up the global supply chains, shipping, etc. You've got Russia's invasion of Ukraine and everything that's doing to commodities, markets, prices, etc. around the world. The worst case scenario here, if they do go to 4% next year, mortgage rates are into 7%. Are we looking at a recession? Are we looking at we're talking about mortgage rates of 7% perhaps. You and I are old enough, we can remember, even I guess around just before the GFC, they were pushing double digits in New Zealand.
Yeah.
Are we looking at that again? And that is going to be a shock for a lot of people who perhaps have only owned property in a low interest rate world, isn't it?
Yeah, definitely. So, there are a whole lot of people who have entered the market over the last 5 or 6 years who have only seen interest rates decline. And there would be people who have just entered the market in the last year or so who came in with a mortgage rate of 2.5%. And here we are already at 5.5%, potentially going to 7%. So that's going to have a material impact on those households. But the 2.5% rate of last year was never normal. That was always an emergency setting, and banks were testing their customers on much higher rates, around 6.5%. So in theory, these people should be able to absorb a lot of these increases based on what banks had tested them on when they got their loans. But yes, we're certainly living in interesting times, highly uncertain. Chance of a recession, well, I think with every rate rise, the chance of a recession increases. They're trying to engineer a soft landing, but as history suggests, it's very difficult engineering a soft landing. On their own forecast, the Reserve Bank has the housing market falling 15%, which takes you back to the start of 2021 in terms of nominal levels, a lot fairer level for house prices. But with that negative wealth effect, with the impact on confidence, you could easily slip into a recession in that world.
Now, we often focus on borrowers, obviously, when interest rates are rising. But I guess if for those people out there who perhaps don't have a mortgage and have savings, they might be quite pleased with what's going on at the moment, because obviously mortgage deposit rates, rather saving rates, have been incredibly low in recent years, and hopefully from the perspective of those savers, they're now going to go up.
Yeah, I mean, I remember having a discussion with you about this in reverse, where interest rates were being slashed. You certainly weren't hearing much from people wanting to buy a home, but we heard a lot from savers about how they were struggling to live on their savings with a 1% term deposit rate. Now the reverse is happening, where savings rates are rising and will continue to rise as the cash rate goes higher, and that's giving them more income to live on, but of course punishing those with debt.
Now, the other thing is, it's not that long ago that we were probably sitting here talking over email or something, or on the phone, about the problem of reserve banks, or the problem reserve banks were having with a deflationary world, i.e. trying to generate inflation, and people were wondering whether they even could do that. Do you think we've had our answer now?
I think we have, and I think the key is it's not just monetary policy, it's also fiscal government policy. For the first time in a very, very long time, we've had both governments and central banks stimulating at the same time. We didn't get it after the GFC. We got it with the coronavirus, and both governments and central banks effectively pumping in trillions of dollars globally was enough to generate growth, was enough to generate inflation. And then of course we've had these geopolitical issues and issues around COVID, which have caused supply chain problems, causing the spark in inflation. But the growth and the normal inflation was there to begin with, and I think we have answered that question, that when central banks and governments get together, they can generate growth and inflation.
Yeah, absolutely. Now, look, if we just cast our minds ahead to the next OCR review, so obviously 6 weeks down the track, we'll be in July, which, the year's rattling on by. One of the things I thought was interesting, just sort of having a look ahead after Wednesday's OCR review, is that the next Consumer Price Index release is after the next OCR review. So that means the Reserve Bank doesn't have that before it reviews the cash rate again. Obviously, the last one was 6.9%. I mean, we're looking at perhaps something north of 7. So does that, in effect, really lock them in to that next 50 basis point hike?
I think so. I mean, they're clearly focused on inflation, so they want to see inflation turn south, and they're not going to see inflation turn south in the next reading. The next reading, which is for this quarter that we're in now, is going to be around 7.2%, so another little move higher from 6.9. So that's not going to satisfy them. We're really waiting until the back end of the year, where we can see some signs of inflation coming off. So I think the next 2 meetings are pretty much locked in with this 50 basis point movement, and we're going to see a cash rate of 3% by August. So quite a sharp increase in interest rates even from here.
It is indeed. I guess just going back to the geopolitical issues, I mean, what if before July, for example, let's say Vladimir Putin pulls the plug and says, right, enough's enough, I'm pulling out of Ukraine, or the Chinese government gives up on its zero COVID policy and global supply chains improve. I mean, to what extent will the RBNZ factor those things in if they happen? I mean, I don't believe they will, but if they were to happen before July.
They'll factor them in straight away. And it would be interesting to see how markets are performing in that world. Oil prices would have come off. A lot of prices around food would have come off. Shipping costs would have come off, particularly around the bottlenecks in China, and it would be a much more rosier picture for exports. It would be very satisfying to see that sort of outcome come through. But then the central bank's still going to be sitting there with a 7.2% inflation rate, saying, well, we really need to see this come through in our data before we change tack. So I still think that this is a 2023 story, and it is one where I do think that the cash rate gets to 3, maybe 3.5, and they pause. I don't think they're going all the way to 4%. Like they tell us they need to.
Well, look, it's certainly going to be an ongoing, interesting world that we live in, and the next few months will be very interesting, I'm sure. Look, thanks a lot, Jarrod, for coming in. It's Jarrod Kerr, Chief Economist at Kiwibank, and I'm Gareth Vaughan at interest.com.